Now, insurance space in California has been under a lot of stress. You have come on the show, we've had other guests on the show, and there's been a lot of challenges with this space. And yes, probably it will change. But we want to hear from you what's really going on in California insurance market right now.
I was on a radio interview with a BBC reporter, and at the end of the interview, she told me I was a bummer because I always have to say these tough things. But I'm happy to at least be able to say one good thing is that the insurance industry still believes that California wildfire is insurable. We don't need special government programs to make that happen. Even in the face of hotter, drier climate, where we could have more valuable property near brush that can be more likely to be engulfed in flames, wildfire is still insurable in California. And so we disagree with voices who say that we have an uninsurable future. We don't believe that's true. But we need a system that allows companies to bring in enough money so they have the ability to insure people in the highest risk areas. And that's just simply what we've been deprived of, at least for the last 13 years. And it really started around 2010. We had a new insurance commissioner come in who just decided he was going to hold rates down. And so for 8 years, we had very little movement in rates. And instead of doing what every business does, which is gradually increase your prices as you have inflation, and people can adjust their budgets along the way, and no one really notices how much more expensive things have gotten, we didn't have that in the property insurance market. We had a decade of suppression, so that when we started having these massive fires in 2017 and 2018, companies were ill prepared to deal with some of the realities of these catastrophic fires. And so that's why people have seen these big jumps in their bills. It feels bad because it's all at once instead of having been over an extended period of time. And that was a self-inflicted wound that California policymakers, principally at the Department of Insurance, made. And it's good to remember that because we can fix that going forward. And we should fix that going forward. But right now we're in a stage where companies are just trying to get their capital back in place, trying to make sure that they can keep their existing promises. Because remember, insurance is a promise. It's a promise to be there when people are at their lowest and they need financial support. And so many people focus on, well, wouldn't it be good to stick it to those insurance companies and make sure they can't charge as much? Well, if we do that, then they're not able to serve high-risk areas, and it makes it less likely that they can answer in a time of need, like what are we seeing now? In a month, the insurance industry has just put out $6.9 billion to LA wildfire survivors. That's what we want them doing. And so we have a series of changes that we need in state law to make sure that the insurance industry is ready to confront this hotter, drier future that we think we'll face.
So essentially, what you're saying is that the cost of these, so the insurance companies will insure the houses, and the value of these homes went up a lot. Probably the cost of rebuilding went up significantly too. It's been the last 15 years, right? So, but the insurance rates didn't go up as much as...
They did not. They did not. And if you just think about how insurance company, well, first of all, your viewers may not know, California is one of the few states that has profit and price controls on property insurance. So if an insurance company wants to change its price up or down, they can't just change their sign like a gas station does and charge a different price. They have to go to the California Department of Insurance and work through a very complicated formula for what is a permissible rate level with an approved profit level. And so you would hope those decisions would be speedily made, but the Department of Insurance, they have a lot of work they're doing, but right now it could take between 6 months and a year to change get approval to change your rate. So imagine in an environment where the cost of rebuilding is going up, and that means that insurance companies, they're going to be paying more to rebuild people's homes. And what do you do if your revenue doesn't keep up with that? Well, you have to start making tough decisions about, well, what's the amount of risk of our customers that we can face and that we can support? Because what we don't want is for insurance companies to have too much risk in their business and not be able to pay the claims when they're needed and ultimately have a company be bankrupt. Then where are we? Right? So we still have to pay those claims, and when a company goes bankrupt, what happens is the rest of the insurance industry passes the hat. They give that bankrupt insurance company enough money to pay the claims, but then the way state law works, 100% of what those companies paid when they were passing the hat, they turn around and collect from their customers. And so we all end up paying it in a scenario where one company goes down, their customers are vulnerable, and then we all chip in, and that's how those customers get taken care of. So we don't want a system that fails to ensure insurance company solvency. And the duty of the Department of Insurance is twofold. On the one hand, their job explicitly in statute is to make sure rates are reasonable and fair. But on the other end of the spectrum, it's to make sure that those rates also support a solvent company that can make its promises good. And so they have to keep companies in that zone of being strong but having reasonable rates. And so I think over the last decade or more, the problem has been there's been too much focus on just pushing these rates down and not enough focus on making sure companies are solvent. And when companies' capital is under stress, what do? They have to react, and that's when they start pulling back from the highest risk areas that are going to produce the most claims.
So is this why a number of homes in the Palisade lost their insurance right kind of
Yes.
close to the fire time?
After the big Northern and Southern California fires of 2017, you started to see some market reaction and some companies started to pull back. Then after the big fires repeated in 2018, then you started seeing the general market pull back. But it was really only in areas of super high wildfire risk. And it wasn't perceived, at least in the California legislature, as a statewide problem. It was a problem of availability that hit very high risk areas, but it wasn't like most people even knew in California that there was a problem. Now, as those problems have gotten deeper, now it's becoming much more of a statewide problem that hits more and more people who don't think of themselves in high-risk areas, for sure.
And now you mentioned these companies. So the pendulum has swung. The state has been really on the side of the consumers to the point where insurance companies are losing money. Is that correct to say?
Well, I would argue they're not on the side of consumers. That's a sort of false reality, is pushing companies into a hazardous financial condition on the side of consumers? No, it's irresponsible. And so the Department of Insurance can be on the side of consumers by making sure that insurance companies exist between the two realities of you have to have enough money, but their rates are regulated and they can't be too high. So there's no virtue in artificially suppressing rates to the point where companies have to pull back. Imagine other areas. So right now everyone talks about eggs, and if it's $9 for a carton of eggs, well, what if we told grocery stores you can only charge $4.50 for eggs? Do we think they would sell them? And then will we criticize them when they don't sell them? If you told a realtor, oh, you can't earn 3% on this transaction, you can only earn 1.5%. Do we think they would keep their same staff? Do we think they would keep their same marketing budget? When they wouldn't do certain transactions because it was no longer financially feasible, will we criticize them for that? If we told banks they can only charge half the interest rates they're charging now and all of a sudden they don't make risky loans, will we criticize them for that? So it's the same thing here with insurance. We've had a system of keeping rates at a level that do not allow companies to go into the highest risk areas, and as that's dragged on and on with no relief, it has degraded the financial condition of a number of companies. And so we have to turn that around, but the good news is we can.